What if I told you that a portfolio worth just $50,000 could pay you around $2,100 every single month? That sounds impossible or reckless. And no, this is not another buy dividend stocks and retire next year fantasy. Because here's what nobody tells you up front. Hey, I'm Brian, and I spend way too much time thinking about one question. How do you make money work for you without lying to yourself about the risks? Today, we're going to break down a real portfolio structure that can produce roughly $25,200 a year in cash flow from just $50,000. But here's the warning. The income is real. The risks are real too. If someone promises you the first without admitting the second, they're either selling you something or they don't understand what they're talking about. If you enjoy honest conversations about money instead of hype, consider subscribing. This is Mind Shift Theory. Let's get into it. Let's start with the part that breaks your brain. Most dividend investors spend years chasing yields of around 3 to 5%. If you invested $50,000 into an S&P 500 index fund like VOO, you wouldn't expect it to produce anywhere near $25,200 a year in income. Historically, the dividend yield has hovered around 1 to 2%. That's roughly $500 to $1,000 annually from the same amount of capital. Even a respected dividend exchange-traded fund like SHEED has historically yielded somewhere around 3 to 4%. That means your $50,000 might generate around $1,500 to $2,000 a year. Not every month, every year. Yet somehow this portfolio aims to generate more than $25,000 annually. That's not slightly higher. That's an entirely different universe. So naturally your brain should ask the question, how does anyone get to $2,100 every month without getting scammed? That's exactly the right question. Because the answer isn't magic. It isn't a secret Wall Street loophole. And it definitely isn't free money. Hold that thought. Because before you can understand the income, you have to understand the machine that's producing it. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Imagine you're building a house. Most people obsess over the roof because it's the part everyone sees. But if the foundation is weak, nothing above it matters. This portfolio works the same way. It isn't one investment. It's 3 layers built on top of one another. Let's start with the foundation. The first $10,000 goes into 2 of the most respected business development companies in the market. Ares Capital Corporation, ticker ARC, and Main Street Capital Corporation, ticker MAIN. Business development companies lend money to middle-market businesses that often can't access traditional bank financing. In return, they collect interest and distribute most of those earnings back to shareholders. ARC has navigated multiple market cycles since its launch in 2004, including the global financial crisis and the pandemic recession. MAIN has built one of the strongest reputations in the sector through disciplined lending and a long history of paying regular monthly dividends. Split evenly, this $10,000 allocation is expected to produce roughly $920 each year. No, that won't make you rich. That's not its job. Its job is stability. Think of it as the concrete underneath the house, strong enough to carry everything else. But concrete alone doesn't create a home. You still need the structure. That's where the second layer comes in. Another $10,000 goes into 2 well-known closed-end funds managed by PIMCO. PIMCO Dynamic Income Fund, ticker PDI, and PIMCO Corporate and Income Opportunity Fund, ticker PTY. Unlike traditional dividend funds, these portfolios actively manage bonds, credit markets, and income-producing securities, while using professional leverage to enhance cash flow. These aren't newcomers. PTY has existed since 2003. PDI has operated since 2012. Over the years, they've become favorites among income-focused investors because of their ability to produce relatively high monthly distributions through changing interest rate environments. Together, this second $10,000 layer is expected to generate approximately $1,255 per year. Now, something interesting happens. Your foundation and structure together represent 40% of the portfolio, but they only produce a small fraction of the total income. Which means one question is still hanging in the air. Where does the other 80% of the cash flow actually come from? That's where the entire strategy changes. Every machine has an engine. Without it, nothing moves. This portfolio's engine is also the part that scares most people. And honestly, it should. The remaining $30,000 doesn't go into traditional dividend stocks. It goes into high-yield options income exchange-traded funds designed to generate enormous monthly distributions by systematically selling options on highly volatile companies. One example is YieldMax Tesla Option Income Strategy ETF, ticker TSLY, which generates income primarily from options linked to Tesla, rather than simply collecting corporate dividends. Here's why the yield can become so large. Volatile stocks create expensive options. Expensive options create larger premiums. Larger premiums become larger monthly distributions. During different periods, funds like TSLY have reported annualized distribution rates exceeding 70%, with some periods pushing much higher depending on market volatility. That's the income side everyone talks about. Now let's discuss the part many creators quietly ignore. In 2023, TSLY traded around $20 per share. Later, despite continuing to pay substantial monthly distributions, the share price fell toward roughly $13. That's about a 35% decline in principal value. Think about what actually happened. An investor may have received thousands of dollars in distributions, but they also watched a significant portion of their original investment disappear. The monthly income was real. The capital loss was real too. That's the trade. Cash now in exchange for capital later. This happens because option income funds often struggle to fully participate when the underlying stock makes powerful upward recoveries, while still suffering meaningful declines during sharp sell-offs. Over long periods, that can create gradual net asset value erosion. That's why calling these free money machines is dangerously misleading. They're not. They're financial tools with a very specific purpose. If your objective is maximizing lifetime wealth, this may not be your ideal vehicle. If your objective is maximizing monthly cash flow, the equation starts looking very different. And that brings us to the question almost nobody asks. What happens when the economy turns ugly? Let's stress test the entire blueprint, because this is the part most YouTube videos conveniently skip. Start with the foundation. Business development companies like ARK and Main are exposed to the health of the businesses they lend to. During recessions, loan defaults can rise. Net asset values may decline. Share prices can fall sharply as fear spreads across credit markets. But historically, both companies have demonstrated resilience through diversified lending portfolios and experienced management teams. Income can fluctuate, but these aren't businesses built around one single company or one single trend. Next comes the middle layer. Closed-end funds like PDI and PTY face different pressures. Interest rate changes, credit spreads, bond market volatility, leverage. All of those factors can push market prices well below the actual value of the underlying assets, sometimes dramatically below. The distributions may continue. The share price may not. Now the engine. This is where reality becomes uncomfortable. Options income funds tied to volatile companies often continue producing attractive monthly distributions during turbulent markets because volatility itself increases option premiums. That sounds wonderful, until you remember what usually creates higher volatility. Falling stock prices. If the underlying company experiences a major decline, the exchange-traded fund's net asset value can fall significantly. Your income might survive. Your principal might not. Those two things can both be true at the same time. And that's the nuance missing from so many conversations. This portfolio isn't designed to preserve every dollar of capital forever. It's designed to convert part of that capital into a stream of monthly cash flow. Those are two completely different objectives. So when someone asks whether this strategy survives a recession, the honest answer is this. The income may survive, the net asset value may not. Whether that bothers you is the most important question in this entire video. Now let's ground this in real life. $2,100 per month sounds very different depending on where you live. In a city like New York or San Francisco, it might barely cover rent. In an average American city, it could cover housing, groceries, utilities, and leave room to breathe. In a small town, or if your home is already paid off, it could feel like a meaningful layer of financial independence. That's why I want to be careful with the phrase, passive income. $2,100 per month is not automatically freedom. For one person, it is lunch money. For another, it is the difference between working full-time and working part-time. For someone else, it is enough to cover every basic expense. The freedom number is not a number. It is a function of your life, your geography, and what you have decided actually matters. And that realization changes how you evaluate this entire portfolio. Because maybe the goal was never to replace your salary overnight. Maybe the goal was to create options. Here is the mindset shift that matters. Most people look at a portfolio and ask, how much can this make me? Wealthy people often ask a different question. What job is this money supposed to do? That is a completely different conversation. If your job is long-term wealth creation, you want assets that can compound for decades. If your job is monthly cash flow, you may accept lower future growth in exchange for income today. This portfolio is not a destination. It is a tool, and tools only make sense when the job is clear. Imagine you reinvested even half of that monthly income, instead of spending all of it. Let's say you reinvested $1,000 per month at an average annual return of 8%. Over 10 years, that alone could grow to roughly $180,000. Over 20 years, it could approach $590,000. That is the part people miss. The monthly income is not just spending money. It can become new capital. The portfolio is the printing press. Your job is to keep it running, but only if you do not confuse cash flow with guaranteed wealth. So here is the framework I would use. Not as financial advice. As a way to think clearly, bucket 1 is long-term wealth building. This is where broad index funds belong. VOO, VTI, SHACH, assets you want to own for decades. This bucket is not optimized for maximum monthly income. It is optimized for ownership, compounding, and preserving purchasing power over time. Bucket 2 is cash flow capital. This is where business development companies, credit funds, and options income exchange traded funds may belong. Not because they are perfect, because they serve a different purpose. This bucket is the paycheck bucket. The important part is sizing. I would never build my entire financial future around the highest yielding assets. That is how income chasing turns into capital destruction. And here is the behavioral rule that may matter more than the allocation itself. Review this kind of portfolio quarterly, not daily. Because if you watch it every day, you will eventually react to price swings instead of the original purpose. Emotional decision-making destroys more returns than bad math. So what is the real takeaway? Your problem is probably not a yield problem. It is a clarity problem. If you want maximum long-term wealth, this portfolio may not be the best answer. If you want maximum monthly cash flow, this portfolio may be worth studying, but you cannot judge it by the wrong standard. Here is the trade in one sentence. You are exchanging some future capital growth for higher income today. That is the trade, not magic, not free money, not a secret, a conscious exchange. So the question is not, would I like $2,100 per month? Of course you would. The real question is this. Would you accept volatility, potential capital erosion, and a different definition of success in exchange for that income? Because once you answer that honestly, the portfolio becomes much easier to evaluate. And maybe that was the goal all along. Not to find the perfect investment, to find the investment that matches the life you are actually trying to build. If this shifted how you think, even by 1 degree, hit subscribe. I put together a free PDF that breaks down this exact $50,000 income portfolio, including the allocations, estimated monthly distributions, and the recession stress test assumptions we covered today. It is linked below. And in the next video, I want to apply the same framework to a different scenario. What if you had $100,000 instead of $50,000? Would you build for maximum income, maximum growth, or a hybrid that protects your capital? We are going to run the numbers and compare all three. This is mind shift theory. Wealth is not something that happens to other people. It is something you decide to understand. See you in the next one.